Well, welcome to Investor in the Family Radio. This is Brian Bain, your host, and we're back this week and with a special guest, Wayne Thorp from AAII, the American Association of Individual Investors, likely an organization that many of you are already familiar with, but probably not as familiar as you probably should be, in my opinion. And so we're excited to have Wayne with us today. We're going to talk about lots of details with AAII, as well as some kind of behind the scenes, not behind the scenes, but some of the more valuable services I think the AAII offers that I think I'm excited to learn more about and excited for you on the show to hear as well. So Wayne, thanks for joining us.
Thank you very much, Brian. It's a pleasure to be here.
Well, it's an honor to have you, as I mentioned, and I know you've got an important role with AAII, and you've spent a lot of your career serving individual DIY investors like myself and like our audience, so we appreciate what you guys are doing.
Oh, thank you so much. And actually, I've spent my entire career with AAII, so I think that's a good indication of what kind of a firm AI is. But yeah, I've April 1st, actually this past April 1st, was my 21st year at the association.
Wow, congratulations. That's awesome.
Thank you.
Well, let's do this. Again, like we as always, we had a little pre-conversation before we hit record, and and I mentioned offline that I feel like this is one of those interviews where we could talk about so much, it's hard to know where to focus. But I think what I want to do is, do you mind I'd like to hear your introduction of what AAII is. And I think that'll be a good thing for us to launch off from, to make sure our audience is kind of up to speed. And as far as who you are, I'll leave it at that.
The American Association of Individual Investors, AAII, is a nonprofit investment education membership association. We have around 170,000 members, primarily nationwide. We do have some international members. And for the last 40 years, we're actually celebrating our 40th year this year. For the last 40 years, we have been focusing on our mission of providing unbiased investment education to individual investors. We don't manage money. We don't handle retirement accounts or investment accounts. We don't run mutual funds or anything like that. Our goal is to look at all of the different types of investment strategies there are out there. We don't believe that there is a one-size-fits-all. Everyone has their own risk tolerances, time horizons, time commitments, etc. And our focus is to look at all of the different types of investment strategies that are out there and merely report on them. We look at a lot of academic research. So when we find good, solid investment academic research, a lot of times what we'll try to do is we'll try to take that research, which does tend to be a little heady, a lot of technical terms, and try to translate that into, practical investment methodologies for the individual investor.
Nice. Way better intro than I would have given, as expected. So on that last piece, so you take like all the academic research, and then you take that and kind of translate it into, languages maybe the average investor could access more easily. Where do people find that? Is that for members only? Is that available for free? I guess it varies.
It varies. We do offer a limited access to our website, which is www.aaii.com. You can come to our website and have access to a limited number of articles each month. But, at the end of the day, for a whopping $29 a year, you have access to our website. Our AAII journal, which is published 12 times a year, gives you access to our local chapter network and just a wealth of again, unbiased investor education for $29 a year.
Right. The beauty of being a nonprofit. And the thing is, one of the things about that is it's so contrary to the typical investment, which I say, I want to say media because that's too general, but the typical investment offerings available online, something of a high quality nature for basically $30 a year is usually the very contrary experience that I think most of us are used to. Do you have many situations where people, you feel like maybe don't take what you guys do as seriously because the price point is lower and more accessible?
I have had, I've had some very spirited discussions with many individuals over the years that, you can't provide all that information for $29 a year.
Sure.
Or the performance of some of our portfolios is just too good to be true. And full disclosure, $29 is our base membership. And, we've serviced over 2 million individual investors over our 40-year history. We do offer premium products. We have a few for more people that are looking for a more directed approach to investing. We do offer some premium products at a higher price point that are, model portfolios. We offer some software packages, et cetera. But you can become a member for $29 a year and get a wealth of information to allow you to make more informed investment decisions without ever having to rely on our more premium products.
How do people, and I want to pause right now too and just make sure people know, like, this is not a paid spot for AAII in any way at all. Like, I genuinely invited Wayne on because I just wanted to learn more about the service and wanted you to too. But I realized as we were talking, it may come across that way, but that is not in any way the case. So if someone, one of the things with AAII, as I've kind of gotten into a little bit myself, is obviously there's a lot being offered, as you mentioned. How do you have advice or tips on how people can best take advantage of the service, or like first kind of dip their toes in the water in a way that they can benefit right away without seeing like tons of links and pages and not really know where to go, what to do?
That, and I fully admit, and I've talked to a lot of our members over the years, and yes, sometimes, especially if you're a new member, our wealth of information that we provide can be a little overwhelming. And over the years, I think we've tried to do a much better job of trying to, create that pathway for a new investor, a new member to come in and get the most out of their experience. It really comes down to, what your interests are. We offer some free model portfolios. So, for example, if you're more of a stock investor, and that's, I would say, probably a good portion of our research and whatnot lends itself more towards stock analysis. We recognize that mutual funds are very popular, form the cornerstone of many individual investors' portfolios. But at the end of the day, mutual fund selection is relatively straightforward compared to stock analysis. So we provide a lot of data. We publish on an annual basis a guide of top mutual funds and a guide of top ETFs. So we certainly focus and provide coverage of ETFs, but we provide articles on, stock selection, building stock portfolios, but then we also focus on asset allocation, financial planning, retirement planning, et cetera. But a good portion of what we offer at the association is geared towards stocks. And, just for example, some of the key benefits of AI membership is we track over 60 different quantitative stock screening strategies. And for your listeners out there that aren't familiar with quantitative stock screening, that's basically applying a set of filters, something as simple as I want stocks whose PE is less than its industry average. That is a quantitative filter. You take that filter, apply that to a database of stocks, click a button, and boom, you get, probably in this instance, you would probably get several hundred companies that fall into that category. But based on books that we read, articles that we come across, again, academic research, we are constantly building and testing different quantitative strategies out there. And currently we have a stable of over 60 that we track on a month-to-month basis, each month providing passing companies, which are not intended to be a buy list. I view the stock ideas that we track as our more idea generators. But you can read about the strategies. We have strategies that try to mimic those of Warren Buffett, John Neff, Ben Graham, etc. But you can, pull up this, go to this Stock Ideas area of our website, which is again accessible to all members, and be able to see that these are the companies that pass this strategy at the end of a given month. This is how it's performed over a period of time. So then you can also see, what has performed well over different market environments. But I think just as importantly too is we also track the poor performers, because I think it's very important to know what doesn't work over time as well.
Yeah, so I'm on the site right now, and I did what you said. I'm on the stock ideas area, and you've got all these screens listed, and like for example, a Graham defensive investor utility, or like the Zwig, I guess after like Martin Zwig's. You have all these different, I guess, filters that are designed to mimic the styles of these different investors or aspects of them, like a Buffettology EPS growth or a Buffettology sustainable growth, and so on. So that's the idea, or like a Lynch. So basically, this is, if I click on the Lynch one, the idea of that is going to try to track using filters that should, in theory, mimic a Peter Lynch investing approach.
Again, and that's the key, is to mimic the approach.
Sure.
It may not necessarily mean that these are stocks that, for example, Warren Buffett are invested in. But yeah, try to capture the essence of their strategy. And it's a completely transparent system. So we provide an article that outlines the approach. So again, our focus on education, trying to focus on the elements that individual thought was important, and as probably more importantly is why, for example, Warren Buffett thinks that value is important. And then we, based on, again, the book that we've written, read, the article that we've read, the academic research, we then try to compile these set of quantitative filters that then on a monthly basis, we report those companies that meet these different filters.
When I'm looking at these screens, the top screen on a 10-year return basis has annualized gains of 22.4%. That's that's pretty
correct.
good.
And just just a caveat there is it's important to point out, and hopefully we do a good job of reporting this, is the fact that those performance data, it's back tested, it's not real money. So there's that caveat, and as well as it does not include commissions, bid-ask spreads, et cetera. But even if that, being, I think, aggressive, and, let that be 2 or 3 percentage points a year.
Sure.
So if you're lowering that 21% annualized down to 18% annualized a year,
I'm still happy.
Exactly. Exactly.
Well, and so I guess, I'm curious. So just to use this as an example, if I go with the 10-year, it's estimated revenue, top 30 up, introduction to the use of earnings estimates. I'm sure you know these in like the back of your hand. But so if I click on here and then it shows me passing companies, it gives me about, I'm guessing, 10 or so passing companies. So again, all that's saying is, so basically you're saying, here's the criteria we created and here are the companies that pass it. And then as the individual investor, I look at that and decide, okay, I could, put 5% in every one of these and fill up my portfolio and let it ride, or I can ignore and pick and choose. But basically at that point, it's 100% on me to decide what do I like and not like out of that group.
That's correct. And that's, it comes down to stock screening methodologies. It's, the first thing you do is, try to find a strategy that meets your risk tolerances, your time horizon, et cetera. And then you start looking at the companies that pass an individual strategy, and you get an idea of, you look at the liquidity, the bid-ask spreads, et cetera, the volatility in general, and decide, are these the types of companies that I want to invest in? And then if you think, I can handle these stocks, then yes, at the end of the day, in theory, you can invest in all of the stocks that pass. Some of these screens might only have a handful of companies. Others have, dozens, if not hundreds of passing companies.
Right.
So yeah, definitely our back testing strategy methodology assumes that you buy all the stocks that pass a given strategy on a monthly basis. So again, you might be invested in 1 or 100 in equal dollar amounts. That is how our back testing strategy works. And that's why I think, this isn't a list of passing companies that you should buy. This is an idea generator that if you find a strategy that you feel comfortable with that matches your own personal philosophy, then you can say on a monthly basis, okay, here's some stocks potentially that I could be adding to my portfolio.
Gotcha. So in that historical back testing, each month over month is going to have probably a little bit of a different makeup. Maybe a company will drop off, one will be added and stuff. So in order to mimic that would mean basically recheck it on a monthly basis, more or less.
Correct. And we also strongly encourage people to say, we're rebalancing on a monthly basis, but that's certainly not a methodology that an individual investor should be following, because the commissions cost would just eat you up. And some of these strategies have as much as, 70 or 80% monthly turnover.
Oh, okay. That's good to know.
So for example, if you're looking, some of these strategies are steeped heavily in price momentum. So price momentum is changing, rapidly. So you could be saying again 70 or 80% turnover, whereas others of these stock ideas strategies are based, exclusively on either quarterly or annual financial statement data. So then, in theory, that data is only updating on a quarterly basis or potentially on an annual basis. So you're going to see a turnover that's much lower just because new data isn't becoming available. New data is only becoming available on a less frequent basis.
Gotcha. That makes sense. Do you have? Of course, now is where I would love to just like bring people on and listen to people who have spent, who basically they base their entire investing or a core part of their investing off of like your screens, for example. I know there's got to be thousands and thousands of people who are doing that based upon the reach you've had over the decades. I'd put you on the spot. Do you have stories at the top of your head that you can share? People who their investing involves going to AAII.com, looking at stock screens, and then making their purchases from there.
Most definitely. Part of what I do here at the association is about 3 or 4 times a year I'll go out and speak to our local chapter network. We have about 40 local chapters around the country. It's more of a grassroots organization where at a local level, a chapter will bring in speakers to, again, talk about different types of investments, but more of an educational slant, not a sales pitch for a particular strategy or methodology or product. But from time to time, I'll go and speak to these local chapters, and then through our national events that we have as well. I've met, hundreds, if not thousands, of our members over the years, and I've met a lot of people that said, the $29 or the $300 or $400 that I've spent on a lifetime membership has turned into hundreds of thousands, if not millions of dollars, based on what I've learned and the strategies that I've been exposed to as an AI member.
What would you say is your favorite offering that AAII has, if that makes sense?
I would say it's my favorite, and I also believe it's perhaps the most quintessential offering for an individual investor that we offer. It's called our model shadow stock portfolio.
Okay, cool. That's where I was going to take things there eventually if you didn't. So that's funny too. Okay,
and then this is. I knew we were going to talk about it, but I feel so strongly that this is. When I think of AAII, this is the first thing that comes to mind is our model shadow stock portfolio.
And I'll say this. I've got your March journal here in front of me, and in the back it's got the stock portfolio. It says the model shadow stock. I hope I'm not stealing your thunder. Has the model shadow stock portfolio compared to the Vanguard S&P 500 index. So basically the S&P over the last 10 years averaged 9.7% per year, and the model shadow stock portfolio from AAII the last 10 years have averaged 12.2% per year. And this is where I want to emphasize with listeners, and I know Wayne already knows this. If it's really easy to look at that and think, okay, 9.7 versus 12.2, that's 2.5% or something like that, and you think, okay, that's cool. No, you've completely missed it. Like, open up a retirement calculator right now, and you run some numbers, and you look at the difference 1% annually makes over a period of time, and it is astounding the difference it makes. And so, go ahead.
I hate to interrupt, but you just use the rule of 72. It's like, based on that, you're doubling up the S&P 500 less than every 15 years. So, if you have a 45-year investment time horizon, you're tripling up the S&P 500 without taking on much addition. there definitely is additional risk, but not an unreasonable amount of risk.
Right. Yeah, and it's astounding.
People. Yeah, that's the thing is like people. Yeah, it's when you really get down. It's sort of getting off topic, but I get into. It bothers me when I talk to people and they're so flippant about the expenses that they pay. Either their commissions or how much they're paying for mutual funds and whatnot, and they're like, what's 0.5%? It's like, well, you 0.5% on $1,000 over 30 years, that turns into real money.
Mm-hmm.
And then when you start talking about multiple percentage points over, decades, that even becomes even more serious money.
Right.
So yeah, it is easy to disregard small numbers until you actually start, doing some back of the napkin calculations and realize, wow.
Well, and I pulled up just a generic retirement calculator. Like there's tons of them online people can find. You guys may have one on your website probably. And I was just playing with a bunch of numbers, and for kind of based upon some people that I know, I pulled up situations like, so if someone had say $12,000 in a retirement account right now, so we'll say relatively pretty small, and they could put in $5,000 a year moving forward, and let's say they wanted to retire in 20 years and then have $100,000 to live off in retirement for like 30 years. So if that makes sense. So say someone's 40, they want to retire at 60, have $100,000 a year up until they're 90, and they're starting with 12, and they're willing to add 5 per year. In order to do that, if they have, I think it was 14.84% per year ongoing, and they would die with $150,000 left over at the end, which is just crazy. And again, I realize going from 12.2 to 14.84 is still a big jump, but it just shows that going from 9.8 to 12.2 or 9.7 to 12.2, it just, those few points being that much better than the S&P is a really big deal, is my point.
Oh yeah, definitely. And it's unfortunately, it's a good thing, but it's a bad thing because, people are living longer, which is always a good thing. So it's like, I have, my mom's just turned 72. So I'm like thinking, yeah, you know what, realistically, we still got another 15 or 20 years with my mom, hopefully. So that's good. But when it comes to, living off retirement, that means now we have to be stretching our retirement dollars more and more. And, when I first entered the industry back, 20 years ago, it was always you invest in stocks, you've got your 60-40 portfolio, stocks to bonds,
right.
And then you retire and then you go super conservative. Now, and I've seen that marked change in the discussion over the last several years, especially in light of the financial crisis of 2007 to 2009, is, you can't do that anymore. You have to stay exposed to stocks even well into retirement, unless you are fortunate enough to be independently wealthy or able to accumulate a good amount of wealth. But, for the average investor, you have to stay invested in stocks well into retirement, and even just meeting market returns might not get you there. So you have to be looking at, I fully admit, I wouldn't tell someone to go out and put all of their money into our model shadow stock portfolio, no matter how good our performance has been. But, there is, whether that's, 5%, 10%, 20%, that is very much an individual choice. But if you're looking at ways to boost your return above the market, it's portfolios such as this that allow you to do that.
So tell me, how we talked a little bit briefly about the stock ideas and the screens, and kind of a little bit how the individual investor can use those. Talk to me through the shadow stock portfolio as far as like how is this tool best utilized for individual investors?
Well, the model shadow stock portfolio is a very different beast than from our stock ideas area. The model shadow stock portfolio is actually a real money portfolio that we have been managing since 1993. So unlike our stock ideas, which the performance that we report is hypothetical based on hypothetical backtesting, the 12.8% that the model shadow stock portfolio has earned through the end of March, that's real money. And that includes commissions, bid-ask spreads, et cetera. But beyond that, the model shadow stock portfolio is a fully encapsulated stock investment system. We have quantified our stock selection, our portfolio construction, portfolio management, and stock sell rules. So for an individual investor looking to invest in individual stocks who's willing to commit probably no more than a few hours a quarter, and I say realistically, especially with all the ways in which you can automate data collection these days, realistically, probably no more than an hour or two a quarter, to be able to monitor and manage a portfolio of individual stocks. And, that is, and this is the sort of taking you back through the history of the model shadow stock portfolio. In the early 90s, and I'm not going to bore your listeners with, the in-depth academic research. But basically in the early 90s, Eugene Frama and Kenneth French, two well-known academics, put together this study that they were trying to identify the factors that allowed stocks to outperform the market. Ultimately, they were trying to see whether or not beta actually was the sole explanatory factor for why stocks outperformed the market, and so sort of taking it beyond the CAPM model. And so they looked at a variety of factors. They looked at stock size in the form of market capitalization. They looked at a variety of valuation measures, price to sales, price to book. They looked at beta, and they looked at some other factors. And what they found out was that if you were to invest in the stocks that were in the lowest 10% of market capitalization and the lowest 10% of price to book ratio, so I call it the good 1%, as it were. If you invested in those stocks, you would.
You said market. You said price to book ratio.
Lowest 10% of price to book and lowest 10% of market cap.
Right. Okay.
And invested in those stocks over a long period of time, you would significantly outperform the stock market with a reasonable addition of risk. And they released this study in 1992, and our former chairman and founder of the association, Jim Clunan, who himself was an academic, saw this study and said, well, let's see if we can turn this into a portfolio based on this academic research that an individual investor can follow. And, here we are now 26 years later, and it's a portfolio that's still in existence and is still outperforming the S&P 500 by almost 3.5 percentage points a year. And has, again, it's a fully transparent. It's not a black box system. We explicitly state how an individual investor can select stocks, build a portfolio, manage their portfolio, and then when it's time to sell these stocks.
Well, and I have any of my listeners or readers for any period of time know that how excited I get when anyone has very clear rules for investing, because I've had the benefit of interviewing well over 100 people, if not, well over that. I don't remember the exact number, honestly. And usually I'll end up asking questions about rules for philosophy of investing, rules for your portfolio type stuff. And some people do. And whenever they do, I get really excited because I believe those core things can be the difference makers. Like I love the intro that Warren Buffett has to The Intelligent Investor, talks about, there's two things that you need in order to be a successful investor over a lifetime. You don't have to be really smart or have some major crazy advantage. So basically, you need some kind of a reasonable system for making decisions, and then to protect that system from your emotions, basically. Mm-hmm. And so basically have rules and then stick to your rules. And, here you guys have laid out very clearly what are the rules for the criteria that must be met to be purchased, and the criteria for what will lead to them being sold and onward, which, man, I love that.
Oh, yeah. And that's, I've met so many people, and I fall into that trap too. It's like our emotions are our biggest enemy when it comes to investing. A lot of things in life, but investing as well. And it's like, yeah, I tell people in general, when you buy, whether you buy a mutual fund or a stock, I firmly believe that you should know when you're buying that stock or that mutual fund, you should already know under the circumstances at which you're going to sell it. That way, you've held the stock for either, 3 weeks, 3 years, or 3 decades. Once it hits that sell criteria, it's very easy for you to say, you know what, I'm done.
Right.
Now, obviously, you still have the discipline to have to stick to that, but having it written, especially when it's written down, staring you in the face, it's much easier than to say, in the back of your mind, I think this is when I'm going to sell. And then when that happens, then you start doing, that trying to rationalize why to keep it, or you try to negotiate with yourself as far as, I can squeeze out a little bit more, or, it's down 30%, but I'm sure it's going to come back. And inevitably these are the stocks that, a couple months later, it's now down 50%. And so, yeah, having these, clear-cut quantitative rules really are a great way for the individual investor to overcome their emotions that can really do a number on your long-term performance.
Well, one thing that I've started doing lately, I've toyed with it before, but hadn't really been disciplined with it. But lately has been actually keeping an investment journal, and where I will, just process through my thoughts of what I'm thinking at different times about stuff, and then you help kind of process my trends I'm seeing, theories I have, stuff that I want to try out, and also but use that for, filtering my purchases and sales to really think through, okay, why am I buying this? Okay, why am I selling it? And it may sound basic, and I guess it is basic, honestly, but it makes such a tremendous difference, because I think we lose sight of how maybe, I don't want to use the word irrational because I feel like that's too easy of a word to use and it kind of writes it off a little bit. But in reality, like how we're not nearly as rational as we think we are. And, people listening, or I'll hear that and I think, well, yeah, I know that. But it's like, yeah, but not, we may realize it, but not realize how much that's true and how much of an impact that has on our investing. Because again, I'm sitting here thinking, you're trying to get into my mind and the mind of other individual investors, maybe yourself as well. And you look at that, okay, so I'm going to click over here, year-to-year performance for the shadow stock portfolio. And it says, so starting in 93 with $10,000 invested in each one of these things. So basically $10,000 invested in, say the S&P 500 back in 93 would be worth $97,000 today, basically $100,000 today, which sounds not super exciting. The $10,000 in 93 invested in the model shadow stock portfolio leaves you with $370,000. That is 3.7x basically the S&P. And so when you think about, I work in a lot of different audiences, and I've got a lot of friends in the personal finance space. I've got a lot of friends in the investing space, and usually there's different focuses in those areas. And in the personal finance space, there's a lot of the idea, I think with a lot of people that just really burned by the financial crisis, and then maybe even the internet bubble before then. And there's just this idea that, hey, stocks are risky and dirty and stay away from them. Just, be a boglehead and index and let it ride, which honestly, I joke, for a lot of people, make your own decisions. And for a lot of people, that honestly is a great solution. So I'm not trying to bemoan that.
Not even the great solution, the best solution.
Yes, yes,
exactly. There are people out there that they should totally be invested in mutual funds.
Exactly.
And individual stock investing is not for everyone.
Exactly. And do not in any way want to undermine that. That said, it's hard to look at these results and obviously know that historical results don't guarantee the future and that kind of stuff. But you think, man, if maybe you index a little less and model shadow stock portfolio a little bit more, it can make a big difference.
Yeah, and one caveat that I think is worth pointing out is being believing in a system and sticking with it, whether that's the model shadow stock portfolio, any different type of stock selection strategy. To be brutally honest, the last couple of years has not been very good for our portfolio. We have lagged the S&P 500 over the last couple of years.
But really, small caps have.
And that's what I was going to point out is the fact, yes, small caps and value have underperformed the last couple of years. But in the 26-year history of the shadow stock portfolio, we have never underperformed the S&P 500 by more than 2 years in a row.
Wow.
So you might have, and that's the key is, you have to be able to willing to put up with that short-term weakness relative to the overall market in order to enjoy the long-term outperformance. Well,
it makes you think about that study. I guess it was a study. As soon as I start saying it, you'll probably know way more about it than I do. But, Peter Lynch's Magellan Fund with Fidelity obviously had legendary status in terms of, I don't know if it's 13 years, something like that. I feel like the average return was like 29% per year. It was something astounding.
It was pretty impressive.
It was astounding. But I'm told that the average person who bought into the Magellan Fund during that period of time, like either broke even or lost money because it was like, oh, the Magellan Fund's surging. Let's, I don't want to miss out. And then it starts tanking and you sell. It's the whole,
That is, and then that's, if there's one thing, and that's, sorry, I didn't mean to cut you off.
No, go ahead.
There's one thing I always, that's the biggest, one of the biggest drawbacks when it comes to investing in mutual funds, and that's one of the biggest advantages of investing in individual stocks on your own, is for the individual investor, mutual funds typically buy and sell at the worst times. Mutual funds historically is sell low and buy high.
When you say mutual funds, you mean basically investors' approach to mutual funds, like for example?
Well, it's because of the herd. Okay. That's typically redemptions are coming in. So you're selling when the market's going down, which is that's when you shouldn't be selling, and you're buying, and then everyone floods in at the very top. And so if you're an individual investor with a long-term so you might be looking at this mutual fund as like, I'm going to hold this mutual fund for the next 20 years, but you're holding it over the long term. But the behavior of the portfolio is very much a short term. So it's selling high and selling low and buying high, which is counterproductive. Which is why, the performance that you often get from a mutual fund isn't that reported performance. Whereas with individual stocks, you buy when it's most advantageous for you, and you sell when it's most advantageous for you.
So with the Magellan Fund, for example, and let's just say it was 29% per year. I think that may not be exactly right, but it's close enough. And so when I was talking about the underperformance for the individual investor, I was meaning basically like if me, Brian, I am buying the mutual fund, when it's surging and then selling when it's falling. So again, buying high and selling low. So I'm getting a bad experience from that, a bad return overall. But if I'm understanding what you're saying correctly is, well, that 29% is the stated kind of like return. But even if I had bought at the beginning of Peter Lynch's time and held all the way through and sold at the end, I would not have seen even factoring in fees, I would not have seen 29% per year, because as other individual investors were buying and selling at bad times, the mutual fund has to respond to that, and therefore they're being punished. So really, even if someone rode it all the way through, no one would have experienced 29% per year.
Correct. And that's,
what?
And, that's crazy. That is that's a thing that a lot of people don't think about when they when they think about mutual funds. Is they think it's a great it's an easy way for me to get this performance without having to do a lot of legwork and things like that. But from a tax efficiency standpoint, and what the individual investor would be doing, mutual funds are typically doing the complete opposite of what the prudent investor would be doing over a market cycle.
Interesting. Whereas with an ETF, for example, technically that same dynamic exists, but usually I guess ETFs are, obviously they're very small ETFs, but the larger index ETFs, I guess, are of a scale that it's not material enough to matter.
At the end of the day, it doesn't, what's been going on right now over the last couple of weeks, over the last couple of months is, I don't know the statistics, but I have to believe there's probably been net redemptions for mutual funds versus net inflows. But as an individual investor, if I'm a long-term, I'm either doing my dollar cost averaging or buying on the dips and things like that. So I want to be putting my money into it, but instead people are pulling the money out, which is, hurting, I'm buying at a lower price. But at the same point in time, it's counterintuitive to what I would be doing as an investor. I wouldn't be selling through this market volatility. If nothing else, I'd at least be holding, if not, trying to take advantage of some short-term price inefficiencies and adding my positions.
What? And again, when you have some kind of rules, whether it be the rules from the model shadow stock at AAII or elsewhere, you can make decisions in erratic market times like now. Again, this is being recorded in mid-April 2018. You can make decisions and not be super scared about stuff, because you can look at, okay, does it meet my criteria? I can buy it. It doesn't matter if markets are at all-time highs or lows. Again, obviously if there was a big major bear market, everything would get dragged down with it. But you can only factor in so much when you're making your decisions. But it just helps. Like, okay, it meets my criteria. I can buy it. It doesn't. I don't. That just
exactly, and that's getting back to what we were talking about a little while ago, is having things written down. Whether it comes to investing, in a completely different related field, it's there's a wealth of research out there that shows that if you want to lose weight, the best way for you to lose weight is to food journal. Write down what you eat, so it's staring you in the face. just the same in investing. You buy a stock, you write down what's going to force you to sell that stock going forward. You can't lie. I mean, you can trick yourself into ignoring it. But, when it's written down there in black and white, it's a lot harder than to have that mental account in your head to say, okay, this is maybe when I'm going to sell.
That's really good. I want to be respectful of your time. Let's wrap things up. I'm curious, just because we started talking about funds and indexing, which, obviously it's just a huge thing that a lot of people just default into. And again, I think for a lot of people, it's a great way to invest. But you start hearing things, and I've heard even John Bogle from Vanguard make comments about potential concerns if indexing becomes too big of a thing. Do you what can you speak into that as far as concerns about indexing becoming too popular and the impact that can have on the markets and individual investors as well?
Honestly, that's one of the reasons why I think individual investors, the best market segment for individual investors is in the microcap value segment, such as the model shadow stock portfolio.
Right.
Because in this segment, professional investors, high frequency traders, or mutual funds can invest in these stocks.
Too small.
So you're competing against other individual investors. So someone who has, the time, the knowledge, the wherewithal, the patience, and the discipline can invest in this segment and do well and not have to worry about competing with, the Goldman Sachs of the world with, $100 million research departments and things like that. Looking at the numbers and looking at the money that's invested in index funds, there's a lot of money there. And, you get some of these index funds, starting to exit the market, they become the market.
Right.
So, I do believe, and I've met Jack Bogle on multiple occasions. I've worked with him actually on some white papers for the CFA Institute over the years. And so, I will defer to Jack. And so if Jack starts saying that, his own firm that he created might be coming too big for its britches, I think that's definitely something that the individual investor should probably sit up and take notice of.
Sure, no doubt. Wayne, as mentioned, I could talk to you for hours. This is great.
Well, I hope we can talk more in the future.
Yeah, no, that would be great. But hey, thank you so much for giving us your time today. I know it's valuable, and I know you've got a lot going on. And but hey, it's been and we really appreciate you joining us.
Well, and if you don't mind me saying, if you're interested in the American Association of Individual Investors, to prove that this truly is not a sales pitch, if you've liked what you've heard about this last hour or so and have additional questions, feel free to contact me directly. My email address is Wayne, WAYNE, @AAII.com. And if you think you might be interested in the American Association of Individual Investors, reach out to me, and actually I can even set people up with complimentary memberships so they can at least get some exposure to see whether or not what we're doing here is something that might interest them.
Awesome. Man, Wayne, that was great. We didn't talk about that in advance either. That's really kind. Thanks for extending that to our audience. And man, thanks again. Have a great rest of the day.
My pleasure. Take care as well. Talk soon.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.